Uber shares are up over 60% year to date in 2025. And of course, I'm happy about that. I own Uber stock in my portfolio. And I told you all that Uber was the best stock to buy in 2025 when the year started. And I've been saying that, repeating that every month here in 2025. And so I'm happy that the stock is performing well. I'm happy that I've made gains on Uber stock. And I'm happy that those of you that have followed that recommendation have also made significant gains as well. In this video, I wanted to dig deeper into Uber's latest quarterly earnings results and answer what's going on with the company. I know many of you are interested in Uber stock because of my high recommendation for this business, and I wanted to share with you the details from the company's latest performance. I also wanted to share with you my updated discounted cash flow valuation and any changes I may have made since the company released their quarterly financial results and held a conference call with Wall Street analysts. So without further ado, let's jump into these results after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right. Uber CEO Dara Khosrowshahi talked about the company's latest results in a conference call with Wall Street analysts. By the way, I think Uber CEO Dara Khosrowshahi is one of the best CEOs right now. Of the roughly 300 companies that I'm following, I certainly rank his performance up there among the best. What he's been able to do with this company, turning it around from a money-losing business that was generating customer growth based primarily on incentives, has really turned around the performance of Uber and the industry overall. The decisions of this management team and the direction they took the industry has made this industry profitable for many investors, not just investors in Uber stock, but I've also rated Lyft stock as a buy. I've also rated Grab stock as a buy and others in this industry because of the dramatic turn. As you know, I don't like industries that are fiercely competing on price and fiercely competing on promotion and incentives. And that's where this industry was before this big change, where all participants followed the lead of Uber, which took a turn for fewer incentives, fewer promotions, and organic customer growth through just offering what it offers, right? Just convenience to the consumer. Convenience is the one thing over the previous few years that consumers have shown a willingness to spend money on over all else, apparently. So in its most recent quarter, Uber said that they achieved all-time highs in both audience and frequency. More people are using its app, and people are using the app more frequently, both for food delivery and rideshare. There was robust growth in trips, in gross bookings, both up 18%. They achieved new highs for adjusted EBITDA, GAAP operating income, and free cash flow. And more importantly, the company said they are expecting more of the same strong performance in the third quarter, forecasting high teens in gross bookings growth and low to mid 30 percentage points increases in adjusted EBITDA. No, not adjusted EBITDA, just EBITDA. So great performance from Uber that justifies the stock price increase. The stock price increase hasn't been based on hype or enthusiasm. It's just been based on fundamental performance improvement from the company. In fact, if there was a measurement of hype surrounding Uber stock, it would be significantly negative for the most of 2025. That's why the stock price was so cheap coming into the year, because of all of the negative sentiment. It was basically the opposite of Tesla. Tesla had all the hype and all the momentum. Investors were overly excited and they were falling for anything the CEO of that company was telling them. And one of the things the CEO was telling investors was that Uber was going to be out of business. Well, not directly saying that, but indirectly saying that by saying that Tesla is going to launch their own app and their own rideshare that's going to generate trillions of dollars in revenue, and that was going to propel Tesla to become a multi-trillion-dollar company, far in excess of any other company. And if Tesla was going to achieve those kinds of results, it meant that it was going to take significant market share away from Uber, and Uber's viability in the long run was under question. So it had like the opposite of investor enthusiasm, the opposite of momentum, and the opposite of positive sentiment going into 2025. And I saw that as a great opportunity. I saw that as a great opportunity to buy a company that's generating significant growth in revenue, in cash flow, that operates a great business model, an asset-light business model, bringing together those that are providing the rides and those that are purchasing the rides. So that's continued. And to be sure, and I've talked about this extensively also, there's still a risk that Uber loses significant share when driverless technology becomes more broadly available. Right now, Uber's having success in partnering with others, and it's still thriving. But there is a risk that in the longer term, Uber's business does get cannibalized by rideshare, and Uber's business does get uh, hurt as a result of that. But I think those risks are overblown, even though they are still existent. So consumers who visited their apps nearly 30 billion times over the past 12 months, 30 billion visits to its apps over the previous 12 months. That's huge. And one of the ways Uber is benefiting and monetizing is through advertising, in addition to monetizing through sales and direct orders. It's also monetizing through advertising. And the more people visit the app, the more room there is for Uber to increase its advertising revenue, which is a lucrative, high margin business. Uber CEO saying that both mobility and delivery, their retention rates are higher. They are 35% higher than single business consumers, and they generate 3 times the gross bookings and profits in single business consumers as well. So what this alludes to is more specific companies that address a specific category, and that's talking about Lyft, which only does rideshare, and DoorDash, which only does delivery. Investors are curious why Uber does both food delivery and ride sharing, and does that put them at a disadvantage against these other companies that can be more focused? And Uber CEO saying like, no, we're benefiting from this because of this dual offering. Consumers that use both end up spending a lot more money. They generate more bookings, and they probably stay with the company longer because they're more entrenched on the platform. So you might be wondering, with this 60% increase in price in this year, if Uber stock is now overvalued and it's trading near its 52-week high. But according to my valuation model, which I updated today, the intrinsic value per share is still about 25% higher than the current market price. And the forward PE ratio also is relatively attractive. So I still like Uber stock even after it's up 60% year to date. I still think there's significant room to run. I think the partnerships that it's making with ride sharing companies throughout this year has lowered the risk of the downside with Uber, and the development or the lack of development in Tesla's driverless technology and the lackluster improvement, right? They are testing and it's moving forward, but it's nothing to write home to mom about. And so that has extended the lifeline to Uber, which gives it more time to develop these partnerships. Remember, it partnered with Lucid and a software company to provide the autonomous technology, and it's going to be launching its own driverless service that it owns and operates. So it's got time because Tesla is spending so much time in telegraphing its plans so far in advance and moving forward so slowly that Uber has time to deal with that ahead of time. And I still like the company's prospects longer term. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.